Good afternoon. It is Wednesday, February 7th, 3:12 p.m. Markets have 45 minutes to close, and it's another wild ride. They were down heavy. They came roaring back with the 10-year auction. Yields started to go up again. Stocks came down. I don't know where it's going to end today. They're all over the place right now. You can't even keep up. So I don't want to get distracted, though. I had said about last week or the week before, the four things I'm watching: the VIX, the dollar, the 10-year, and 1340. Nothing has changed in my mind, okay? And this VIX has been all the rage this week. It has been all about the VIX, and we'll get to that. But right now, I guess just for levity, let's bring back the usual suspects. There they are, the usual suspects, all right? These Fed heads, these academics, all right? You notice I got William Dudley. He's circled, all right? Because he's retiring, all right? And they're looking for a replacement. If you remember General MacArthur's famous speech, General Douglas MacArthur, old soldiers never die, they just fade away. So he's retiring, but these Fed heads never really fade away, right? They just go around the country, make speeches, right, and cause problems and wreak havoc. They're supposed to be good stewards of the economy, they were saying the other day, right? What nonsense. Just like Janet Yellen. She wasn't even out the door when she made the comment about, well, don't you think stocks are overvalued? Right? How come she didn't notice it when it was on her watch? But Friday afternoon, right? Oh, don't you think stocks are overvalued? They don't die. They don't fade away. They just make the circuit. Right? They'll show up on CNBC every now and then, right? And they'll put in their 2 cents, right? On November 6, 2017, New York Fed President and CEO William C. Dudley announces plans to retire in mid-2018. The search for his successor is underway, selecting a new president for the New York Fed. The responsibility for selecting a new president is held by the Class C and eligible Class B directors of the New York Fed's Board of Directors. They're responsible, right, for selecting a new president. Not the people. These are unelected, okay, people that have wormed their way into the system. And this is what has been, foisted upon us. Those eligible directors have formed a committee to run a nationwide search to identify a broad, diverse, and highly qualified candidate pool for the next president and CEO. Maybe you'd like to apply for the job. Huh? Search committee. The search process is expected to take 6 to 9 months, during which time the search committee will solicit input regarding the key attributes that are important to the ideal presidential candidate from stakeholders across the New York Fed's district and beyond. Stakeholders will include representatives from academia, there you go, manufacturing, I doubt it, community development organizations, not-for-profits, industry, small businesses, minority and women-owned businesses, and labor. Members of the search committee will also meet with several of the New York Fed's advisory groups, including those representing regional interest communities, small businesses. Identify a diverse slate of potential candidates. Interview a range of candidates reflecting the diversity of the qualified candidate pool. And recommend to the full board, excluding the Class A and any ineligible Class B directors, one or more candidates for consideration for appointment as president and CEO, subject to the approval of the Board of Governors of the Federal Reserve. The search committee has engaged Spencer Stewart, a national executive search firm, and Bridge Partners, an executive search firm with unique expertise in attracting and retaining senior, diverse executives. So they had to go out and hire 2 search firms on our dime, okay, to pick the next Fed head. It's wicked. It's sinister. This has to stop. I don't know when it does, but we're not going to get back our markets or our country until this comes to an end. What they are looking for, here's, if you want to put your resume in, here's what they're looking for. How will the next president be selected? Someone who can build a team and foster the right kind of community within the Fed. I gotta laugh. Make sure we are focusing on diversity, integrity, values. A blend of skills, both technical and personal, which is hard to find in one person. Inclusive search as possible. Not just candidates, but listening to communities. Hired 2 search firms. The president of the Fed of New York, now this is it, people. The president of the Fed of New York becomes vice chairman of the FOMC. So this is not just some backbencher from St. Louis and Kansas City. You know, this is the chairman of the FOMC, right? He has to wear many hats. Community involvement. These guys get into their limos, okay? They go to downtown Wall Street, right? They sit on the 10th floor and have these academic debates, right? And then they get shuffled back. Do they ever even see the community that they're dealing with? These elite eggheads that fly into Davos once a year? Good decision making. Ability to think independently when making those decisions. Someone who has that great vision. That great vision. Well, what is their vision? Besides just destroying the dollar. Creating boom and bust cycles. All the while skimming off the top. So, that's it, people. It's going to take 6 to 9 months. They have to hire 2 search firms. Okay? I can make it very simple. All the Uber doves, raise your hand. That's it. Are you an Uber dove or just a plain dove? That's it. So this is where it's going, people. Unelected officials that have usurped the free market. Now, speaking of these usual suspects, I might have to add a couple of names. Because if our president wants to wade into this cesspool that's these stock markets and make comments and tweets off the time, well, maybe he should be added to the list. I know these are just banksters, okay? But, you know, he wants to be involved in this market, up or down. And he sent out a tweet today in the old day. And he's right. Here's the thing. He is right. I've been saying it for years. In the old days, when good news was reported, the stock market would go up. That's true. Good news used to be good news. But in this wicked and sinister market that has nothing to do with fundamentals, it only has to do with cheap money supplied by the Fed, okay? Good news is bad news. And bad news is good news. In the old days when good news was reported, the stock market would go up. Today, when good news is reported, the stock market goes down. Big mistake. And we have so much good, great news about the economy. Now, he's right in that one sense. You know, good news should be good news. Not just for Wall Street, but for Main Street. He's wrong in the sense, what's this good news? What's the good news he's talking about? Where is this good news? I don't see it. All of a sudden, 2.9% wage growth. Whoa, whoa, whoa. Everybody's getting raises. Everybody's getting bonuses. That income tax restructuring. All these companies are going to give money back to employees. No, they're not. They're going to buy their own stock back to get this stock market jacked up again. So I got to add his name. I think he's going to become one of the usual suspects. And then this Mnuchin guy, right? Why leave him out, right? We want a lower dollar. Oh, no, we want a higher dollar, just not now. The havoc that he caused in these markets. And if you're going to put in Mnuchin, you might as well throw in, you know, his wife. She's attached to him at the hip, you know. Mnuchin. I'd like to welcome you to Mnuchin land, right? Couple of more usual suspects. All right, let's get down to business, people. Oh, while I'm still on the usual suspects, what do I always say? They go around the country and the world on our dime, right? And they give all these speeches, and they want to give you the impression that they're having this really thoughtful debate. Now, this was early this morning, and this is how fast things are changing. U.S. government debt prices were slightly hot. The prices were higher. The yields were coming down, which is what they wanted. Get these yields down, right? U.S. government debt prices were slightly higher Wednesday as investors continued to keep abreast of the volatile trading seen across international and domestic markets. The yield on the benchmark 10-year note was lower at around 2.76. It was down to 2.76 at 5:10 a.m. this morning, right? During Tuesday's session, U.S. government debt yield slipped as stocks in the state saw a volatile trading session. Okay? Blah, blah, blah. Some of the reasons that investors gave to the swings included fears over interest rates, obscure volatility funds, these obscure volatility funds that use leverage. That's what Carl Icahn was talking about yesterday. These weapons of mass destruction, this volatility, the VIX, the inverse VIX, right? And we'll get to that. And computer-driven trading, these algos. We talked about that yesterday. This is not over, people. You know, this reminds me. You know, these markets. It reminds me of. You ever see those plants, carnivorous plants? They eat bugs. They eat insects. Right? They eat ants. Right? They're so attractive on the outside. Right? The scent, the color. Right? The aroma, the nectar, they're beautiful. You ever see the pitcher plants, right? The bees buzz around, the ants, they kind of crawl on the leaf, right? They're attracted to the nectar. They're attracted to the color. It all seems so pleasant, right? There's that one, the cobra lily, I think it's called. The cobra lily. It's not the usual pitcher plant where they just kind of slide on and they're in the pit, right? They get in and they get in deeper and deeper and deeper and deeper. And the hairs on the leaf, they all point one way. They're sharp little hairs, and they all point one way. And you can go that way. You can go with the hairs, right? You can go with the crowd, but you can't go against the hairs. And as you get in deeper and deeper and deeper, then you get confused, right? Because the leaf has all these little transparent places where, oh, this is the way out. This is the exit. No, it's not. No, it's not. And you just end up going down deeper and deeper and deeper till you get to the pit of hell, right? Then all those like digestive juices come out and that's it. That's what these markets remind me of. Everybody is rushing in. It's like a pitcher plant. They're all going to fall in. It's so easy right now to create something out of nothing. You can't create wealth from debt. Bond market investors will likely turn their attention to new data and speeches. Here we go again. Speeches, you can set your watch by it. It's wash, rinse, repeat. Speeches by the U.S. Federal Reserve on Wednesday. That's today. They're all going to come out. In the economic data space, mortgage applications are due out at 7 a.m., while consumer credit is due out at 3 p.m. Key members of the U.S. Federal Reserve are due to deliver separate remarks Wednesday. Dallas Fed President Robert Kaplan will be in Germany. There you go. He goes around the world on our dime. What does he need to go to Germany for? Dallas Fed President Robert Kaplan will be in Germany, where he is set to appear at the Institute for Monetary and Financial Stability. What monetary? It's unstable as could be. The IMF's working lunch. It's a working lunch. Isn't that nice? What do you think we do here all day? And San Francisco Fed President John Williams is slated to appear in, you guessed it, people, Honolulu. Honolulu. Oh, boy. See, he's not a backbencher. He doesn't go to Cleveland and Philadelphia and Kansas City, right? He goes to Honolulu. At the community leaders' luncheon. Isn't that nice? What do you think we do here all day? Chicago Fed President Charlie Evans will be attending the Iowa Bankers Association. He goes to Iowa. He goes to Des Moines. while New York Fed President William Dudley is set to make an appearance at the Banking Culture Still Room for Improvement event in New York. I wonder how much tickets to that event cost. This is so obscene, people. It's really so obscene. Disgusting. I'm really disgusted with this. All right, let's try to get to some markets here. All right, now the 10-year. The 10-year spiked on a weak auction. Rick Santelli gave it a C-. Okay, and I believe him. U.S. 10-year Treasury yields rebounded to 2.85%. Okay, so they're right back up there. They are up there. They came down, okay, but they're right there again. And we got to watch this because this is what it's all about. These rising interest rates. Treasury yields rebounded to 2.85, the level that sparked Friday's stock sell-off. And stocks right now, they were coming down. They're up, they're down. I don't know how it's going to end today. You know what? I don't know how it's going to end today, but I know how this is going to end. I know how this is one day going to end. It reminds me, this is one of those days. I got some memory jogs. I remember before I married my wife, she was my girlfriend at the time. We were driving. She was doing the driving. I was in the passenger seat. Beautiful sunny day, clear. Roads are dry, sunny, no problem. She's driving. We're on the road. She's doing 40 miles an hour. Really no traffic at all. Boom. Her tie rod breaks, and we're spinning around the highway like this. We did a 180, and I saw the car, which was a van that was behind us. I saw him coming on towards us. It only lasted about 3 seconds. Seemed like an eternity. I had my seatbelt on. I put my hands behind my head, and I said to myself in those 3 seconds, I don't know when this car, is going to stop. I don't know how this when it's going to end, but it's going to hurt. I said that to myself. In 3 seconds, I said, I don't know how this is going to end, but it's going to hurt. And thank God, we just kind of skidded off the highway. We came out of that car without a scratch on ourselves or even the car. And I went back that night and I looked at the skid marks. It was unbelievable. When we pulled over the highway, the van behind us, he pulled over. He said, I never saw anything like that in my life. The tie rod just snapped. She had no control of that steering wheel. And we just skidded off the highway. I really believe that's the perfect illustration for these markets. All it's going to take is 3 seconds, right? Boom. Everyone thinks they got it under control. Everybody thinks they can buy protection, and it blew up in their faces with this inverse VIX. So I don't know when it's going to end, but this time it's going to hurt. We, thank the Lord, walked out of that car. I don't think these markets are going to be so fortunate. The yield on the benchmark 10-year Treasury note was higher at 2.847 at 1:23 p.m., while the yield on the 30-year was 3.12 to 30-year. These bond prices are going up. And I don't want to hear, well, this is the new normal. And the stocks will just readjust. No, they're not. Rates posted a remarkable comeback Tuesday, after sharp sell-off in equities spurred a new slew of bond purchases earlier in the week. The yield on the 10-year note climbed roughly 15 basis points to hold near highs of 2.8, while the 30-year bond added a modest 7 basis points to hold at 3.07. Okay? So we got to watch this. Now, the dollar is strengthening. The euro is weak today. Okay, the euro is like 1.22. The yen is a little stronger, 109, right? But the dollar right now is strengthening. I don't know how long it's going to last. Okay, this counter trend little bump. All right, so I just want to end with 2 things. Technically, I want to look at this gold market. Okay, because it's been discouraging, right, to see this go down. Stocks go down, gold does nothing. Stocks go up, gold goes down. All right. But if we look at this chart, these Fibonacci retracement levels, this is going back to the December low, daily chart. This is your 3-month daily chart. All right, and we had that December low on December, I think it was December 12th at $1,238. Okay, that's the December low. Spike down. Low of the day, not the close. Then we had this beautiful move up, right? And then we had that January high, 1365. It's a $127 move, okay? The 38.2% retracement puts it in at about 1317. And we're flirting with that. At the time of this, we were a little bit under it at 1360. We're basically, at the time of this printing, right at that 38% retracement level. So this is normal. This is normal. If we can hold here, and it's an if, because we don't know how this is all going to play out, but if we could hold here, okay, it's okay. It's okay. All right? The 50% retracement comes in at 1302. All right? Still above that 1300 level. Key psychological level. And then the 61% retracement comes in at 1287. So we have to watch this right now. We have to see if this is just an ordinary pullback before the next leg higher, or if this is something more. I think, it's the jury is still out. So, it's okay for now. Yeah, it's discouraging, little disappointing, but nothing to, to get all bent out of shape over in the short run. All right. One of our listeners, I mentioned about how this nobody wants gold. I called up my gold dealer, spot, $29 over spot. He called up, one of the listeners called up his gold. You can get it for $24 over spot. I'm sure if you shopped around, you might even be able to get it for less. Okay? You're practically getting gold for spot these days. Nobody seems to want it. Because they're all, it's that pitcher plant, right? Oh, I love the nectar. It's so sweet. Woo, boop. That's where I think I think this is a really good contrary indicator. I really do. I want to close with one more thing, and that's this VIX. I mean, you saw the VIX, the way it shot up there, right? I'm looking at this article. Markets are hoping wild volatility is over, but history suggests it's not. The market has seen a spike in volatility, but history shows that February is rarely the peak when this happens. The VIX, an index of volatility, has plunged because now it has come back down. Okay, it's come back down. I think it was down like, I have the numbers here. The VIX was down 19% today. 19% today. 24.10. I don't think it's over, though. I really don't. The VIX, an index of volatility, has plunged, but there likely is more turmoil ahead, according to Data Trek research. Worst months for volatility traditionally have been August and October, a trend that could be exacerbated by November's midterm elections. The volatility storm that has rocked the market could be just getting started if historical trends hold up. Products that track market volatility took focus as and that's these ETNs, these inverse VIX, right? People just think everything's going to be calm, market's going to go up and up and up and up and up, right? They got wiped out this week. Products that track market volatility took focus as the market endured its first meaningful pullback in 2 years. Exchange-traded products that bet against market tumult have gotten shell-shocked, and some even have liquidated. Credit Suisse, we're sorry, we screwed up these markets, we'll close down the product. Unbelievable. Seeing such behavior in February, though, isn't consistent with market patterns over the past few decades. We're not just talking about a year or two. We're talking about a few decades. The VIX goes all the way back to like 1990, something like that, right? Maybe even mid-80s, right? According to DataTrek Research, the firm, in fact, found that the most popular fear gauge on Wall Street, the CBOE's VIX Volatility Index, has only peaked once in February since its 1990 inception. There you go. It has only peaked once in February since 1990. You're looking at 28 years, right? U.S. equity market volatility is deeply informed by seasonality, okay? The VIX spiked past 46 during a whipsaw trading day Tuesday before closing around 37. While many investors likely are hoping that the dizzying movements of the worst of the year, the calendar doesn't back that up. Okay? It's only peaked once in February. Interesting, only the other time was during the market's early 2016 upset. Most other peaks have concentrated around August and October, which have 36% of the annual highs. Okay? Adding January brings the total to 50%. So I don't think this is the end of it, people. I think this was just the prelude. All right? So I'm not going to read the rest of the article, but I don't think this is over. There is one thing I would close with, though. This is my close. This one guy, he was on the internet, all right, on Yahoo Finance, on Reuters, all over the place, right? This is this Velocity Shares Daily Inverse VIX Short-Term ETN, right? Down. It was down like 90%. It's done. It's done. It's toast. Was created to give traders an opportunity to bet against a rise in volatility. Bet against a rise in volatility. The calmer the markets, the more profitable the trade. And this was a great trade while it lasted. It was a fantastic trade while it lasted. Right? It has been one of the best plays out there amid the bulls' long and steady assault on new highs. Okay, this XIV, this inverse VIX, right? All that changed, however, when the stock market began to seriously flame out last week. The ultimate gut shot landed Monday when the Dow Jones Industrial Average was smacked with a record-setting retreat. The XIV dropped 90% after hours following the sell-off, leaving a trail of destruction in its wake. Nowhere was the pain more palpable than on Reddit's Trade XIV group, which counts more than 1,800 members. One of them goes by the cyber handle Lilk Anna. And to say he's had a rough stretch would be a huge understatement. I've lost $4 million, 3 years worth of work, and other people's money, he wrote in a post that's garnering lots of attention. Should I kill myself? $4 million, 3 years, up in flames, and other people's money, betting against volatility. I don't know how this is going to end, but this is going to hurt. It's going to hurt. And then he posted his screenshot, and sure enough, $3,706,000. If he's to believe, wow, brutal. How did it happen? I started with $50K from my time in the Army and a small inheritance, grew it to $4 million in 3 years, of which $1.5 million was capital I raised from investors who believed in me. Lilk Anna explained, adding that those investors were friends and family. Wow. The amount of money I was making was ludicrous. Could take out my folks and even extended family to nice dinners and stuff. He wrote, was planning to get a nice apartment and car or take my parents on a holiday, but now that's all gone. Reddit can be an unforgiving place for those sharing tales of woe. Like Lilk Anna's epic collapse struck a chord, and the feedback, for the most part, was supportive. Hey man, I know others have said it, but I'm here for you, man. Passively aggressive wrote, it may seem like the end of the world, but tomorrow's a new day. Unbelievable. So there you go. Betting against volatility. Blew up. This is some kind of ugly out there, people. These markets. It's some kind of ugly. That's about it, people. Little dreary day out there, actually. I'm going to get out. Try to just get a walk. I need it. So, Lord willing, we pick this up tomorrow. Ciao.